Hey friends, welcome to the third quarter market and economic update. We're glad you're here. So let's start with the market year to date. So this is the S&P through July 31st, up 20%. That's a fantastic year so far. And you can see the little circle down at the bottom, which is a -8. So the market went up at the beginning of the year, backed up about 8% in March when Silicon Valley Bank went under, and then took off again. So we've really had a pretty good start of the year. But you know what? It really shouldn't be that big of a surprise. In 32 of the last 43 years, markets were positive, and you can see a lot of them were double digits, and some of them in the 20 and 30% range, which is obviously pretty good. But here's what you need to know now about the United States stock market. We're a little bit more on the expensive side at this point. And it doesn't mean that, stocks necessarily have to go down. Earnings could always grow and catch up to stocks going up. But suffice to say, you know what? If you said, are we cheap? Are we average? Or are we a little bit closer to the more expensive side? We're a little closer to the more expensive side. And if you look historically, I've got on the right-hand side of this next chart, forward-looking returns, 5-year annualized returns from where we are right now. They're roughly mid-single digits. So what does this mean? Well, from the valuation we have now for the stock market, it probably means returns ought to be more like mid-single digit kind of returns, not these, plus 15, plus 20 type years over the next 5 years. Now, the good news is the rest of the world is cheaper. So next chart, valuations and earnings. On the upper right-hand side here, one of the reasons that the stock market is up so much is because the largest companies, tech stocks, have done better in the first 7 months of the year. In fact, we've now hit the highest point for the top 10 stocks in the last, 20, 30 years. In terms of how much they represent of the overall index itself. So what this is saying is the top 10 stocks represent about 32%, almost a third of the index, while the other 490 stocks make up the other 2/3 of the index. So, those big companies do have a lot of weight on what happens with stocks. If they're going up, the market's going up. If they're going down, the stock market's probably going down some. But keep in mind, this is a marathon, not a sprint. You're going to be able to continue to invest money for the future. And if you have more than 3 years until retirement, keeping your foot on the gas is definitely what makes sense with stocks. Now, the types of vehicles or the types of stocks to own, we're going to talk more about that in a minute. Okay, next chart, inflation. So what I've got here is an orange box at the bottom of the screen, basically from 1991 until now. So this is basically the last 50 years, okay? And what you can see is, inflation was a whole lot higher in the 70s. We all know that. And we've been in this range basically since 1991, so the last, call it 30 years, right? And we broke out of that range recently, but we're getting back into the box. And what that means is inflation's getting closer to back to sort of normal where it should be. And that's good news, but, the Fed's going to have to continue to keep pressure to try to make sure that interest rates don't break back out again, or inflation, rather, doesn't break back out again. Like it did back in the 70s. You can see the 70s over on the left-hand side, and they let it out of the bag again about 1976. And so what the Fed's really cautious about now is trying to make sure that they don't let it out again, which is why they're keeping interest rates so high. Okay, so I made mention a second ago of what types of stocks to own if you have more than 3 years. So you can see there was a period of 14, 15 years in gray here where the U.S. just did exceptionally well. And over on the very right-hand side, you can just barely see it. The rest of the world started to do better, and then the U.S. reaccelerated, and we've seen that again. The U.S. relative outperformance in the last little bit has been better again. But suffice to say that, we could enter a time period certainly where the rest of the world doing better would help us, right? So if all we owned was the S&P 500 U.S. stocks, then that would cause us not to participate in the rest of the world, which is part of why we really believe you need to look to global type holdings. And certainly your target date funds in the 401k plan do that. So we would recommend using your target date funds because those are going to be rebalanced for you daily. You're going to have both U.S. and non-U.S. exposure, and those are items that are going to be adjusted by the investment committee of those target date funds pretty consistently. So we think it's really important to use your target date funds. If you don't use your target date funds, at least consider looking at a global type holding to see if it would make sense to include in your portfolio. And if you ever want to talk about it, call us. We're happy to talk about it. Next chart. In fact, if you consider valuations, ultimately the rest of the world is cheaper than the U.S. by a lot. In fact, what's on the left-hand side of this chart is performance of the U.S. versus non-U.S. And so this orange bar that I have down here at the bottom, the orange square, what that's saying is it's really stretched to the U.S. having outperformed the rest of the world. Will it change eventually? Yes, it will at some point. I don't know when, but that will change at some point. And up at the top of the page, I've got another orange square, and you can see valuations. I mentioned valuations a minute ago. The U.S. is way higher valued than what the rest of the world is. Let me say that a different way. The rest of the world's cheaper relative to the U.S. So at some point that will matter. Again, I don't know when, but your target date funds are going to do things for you to basically try to find the sweet spot over time. So that's why we'd recommend continuing to use your target date funds. All right, so this next chart is a visualization of how much money is in stock when you're further out from retirement. So if you look across the bottom of this chart, what you'll see is it goes from age 20 all the way to age 95. And in considering using your target date funds, effectively what's going to happen is you're going to have way more stock when you're 20 to 45 years away from retirement. And then as you get closer to retirement, you're going to start to add more fixed income or bonds into the portfolio. Look at it like growth versus conservative, right? Equity-focused funds are going to be high growth. But the cool thing is those target dates are going to start to slow down a little bit as you get closer to retirement. They're going to do the work for you. So this is just a visualization of what happens in your target date funds as we all get a year older every year and we get a little bit closer to retirement. And again, next chart, inflation has been coming down. You can see on this heat map a whole lot of red in the middle, and what the red means is, well, that's more inflation, right? But as we've gotten closer into 2023, we do see some yellows, but we're starting to see some greens, and deep green would imply, hey, I mean, we're really starting to whip inflation, and that's obviously a good thing. But the Fed still is worried, as I mentioned, about repeating the 1970s. So we are at a point where the Fed funds rate, the Federal Reserve's interest rate, short-term rates, are at roughly 5.5%. That's the highest we've been in the last 20 years. In fact, 06, 07, we were at 5.25%. 5.5 is where we are now. And the Fed said they feel like they're going to have to stay here for a while, which means that, I mean, the good news is that you can get yields on cash. So if you have money in the bank, make sure that you are indeed getting returns on those dollars. If I look at like a Fidelity money market right now, it's yielding roughly 5%. There are tools that we use that are yielding upwards of 5.25, 5.3. So there are ways to get yields out there in the money, you know, in cash at this point. And the other interesting thing is that bonds really are yielding more than they have in the last 10 to 20 years. And there's a point at which that's really going to become a good value. Again, those are being managed for you in target date funds, but over time, bonds are going to have a compelling value. And is that coming this year? Is it coming next year? Not sure, but I mean, finally on a 10-year government bond, again, to be up in the, 4.25-ish range, man, That's way more yield than we've had over the last decade, 15, 20 years. So there are some opportunities out there where areas are getting more attractive. And finally, what we have here is a chart that basically goes for the last 72 years. And the reason we're showing this to you, think about the gray bar, kind of like target date funds, okay? If we have good, solid diversification. So on the left-hand side, we have one-year returns. And the worst one-year return on that half stock, half bond portfolio is negative 15%. And that's between 1950 and 2022. And by the way, I'll clue you in, that negative 15%, that was last year, okay? But look what happens when you start looking at 5-year periods, 10-year periods, even 20-year periods. The return bands get tighter, okay? So the worst 5-year average annual return over the last 72 years was a 1% average annual return. The best was a 21% average annual return. Obviously, we like 21 better than 1, but you can see the bands are getting tighter, right? So this would just argue why time in your 401k plan matters. So look at the next chart, the 10-year rolling column. What that means is every 10-year period from 1950 to 2022, any 10 years that you can pick out of those 72 years. The worst average annual return was 2%. The best was 16%. I mean, heck, a 10-year, 16% average annual return, obviously, that's killing it. That's fantastic. Look over on the 20-year, though. What's really interesting is the bottom side starts to rise up. So the worst 20-year average annual return for half stocks, half bonds, which, again, is kind of akin to target dates. It's not exact, but ultimately, the best example I can give is if you look at a 20-year average annual return for half stocks, half bonds, the worst you did in the last 72 years is a 5% 20-year average annual return. It's pretty good, and the best is 14%, okay? So again, if you think about things in terms of the target date funds, that's what's happening. It's time in there that matters, right? Just continuing to keep your foot on the gas. So if the U.S. ultimately has some bumps along the way, like they did back in March when stocks dropped 8%, that's just an opportunity for you to continue adding money and keeping your foot on the gas toward retirement. Now listen, if you're getting a few years out and you need a deeper dive on planning for retirement, we want to talk to you. We want to be helpful. Please do reach out to us. You can reach out to kelly.eldridge@proplanwealth.com. You can reach out to chris.beard@proplanwealth.com. We're always happy to hear from you, and we do want to be helpful in helping you get closer to financial wellness. So we look forward to talking with you soon. Thanks so much for tuning in, and thanks as always.